Home equity is an awful investment. It is unsafe, illiquid, and the rate of return from home equity is always zero. I'm going to tell you why and how applying this truth helped me build wealth.
You're going to learn how to profit from things that only make most people poorer. This is Get Rich Education with Keith Weinhold.
Hi, I'm Keith Weinhold. This is Get Rich Education. In fact, my most well-read and most shared Forbes article that I ever wrote was about why the return from home equity is always zero and what to do about that. Home equity is your skin in the game. It's the amount of real estate that you own minus how much you owe on your mortgage balance. So let me give you an example. A $500K home, if that's your home's value, and you owe $400K on the loan, the difference, $100K, is your equity position or your skin in the game. Well, let's look at this. If your $500K home, let's say it appreciates in value over time up to $600K, let me ask you, did it matter how much equity you had in the home? Did that affect the appreciation rate at all? No, it had absolutely nothing to do with that 20% appreciation you got when the home went from $500K to $600K. Appreciation occurs for reasons that take place outside the walls of your home. Things like population growth in an area, and migration patterns, and wage growth, and the remaining availability of developable land in the area where that property is. So it's completely independent. It has nothing to do with the amount of equity that you have in your home. But conversely, say instead your $500K home drops in value to $400K over time. Well, now what happened to your $100K of equity? It's completely wiped out. It's totally gone. And now you begin to understand why home equity is unsafe, yet its rate of return is always zero. Now, homeowners typically have homeowners insurance. One might know that as hazard insurance to protect you against losses due to, say, a fire or a flood or a tornado or something like that. But there's no such thing as home equity insurance. So your $100K of equity, though it doesn't provide any return, it's also exposed to the market forces and completely vulnerable to a downturn. Home equity is often targeted as low-hanging fruit in the event of some sort of lawsuit. So say that you owe the bank a lot of money, meaning that your equity position is low. Well, if you owe the bank a lot of money and you get sued for some reason, banks have been known to hire an attorney to represent you on your behalf. And why would banks do that? Why would they care about that? Because they care about your financial condition since you owe them a lot of money. Well, conversely, if you don't owe the bank very much money and you have a lot of equity in the home yourself, you're often left hanging out there. The bank's not that concerned about your financial condition because you owe them little or nothing. Sometimes insurance companies don't want to pay claims, and you would rather have a bank be interested in your financial condition if you ever need to have that fight. But you know, things like that really aren't that common, though it could happen. There are more common scenarios, of course, like if you lose your job or you lose your income source for any reason, well, your bank is going to be a lot more motivated to work with you and give you the workout or give you the short sale if you still owe them a lot of money. If you don't owe them very much, well, then they would have an interest in foreclosing on the home because the home that they can get would be worth substantially more than what you owe the bank. So more equity in your property is more risk in a lot of senses, but a lot of people think about that the opposite way. They think that more debt on their home is more risk. That's not necessarily true. Hey, if you're getting some good value from this video, I'd really appreciate the like that you would put on this video. That's also instructive to me that you like this sort of content. Hey, maybe you'll like debt more by the time this video's through. I practice what I preach. When equity accumulates in my primary residence, I harvest it out before it accumulates. Remember the velocity of money concept? You need to keep your money moving and turning over in order to earn a rate of return. So we talk about equity harvesting much like an old crop of cabbage or carrots or nectarine would rot in the field or the orchard if it's not harvested. The same thing happens to your return on money. So harvest it. And when you harvest equity out of the home, either with a brand new mortgage or a second mortgage or a HELOC, a home equity line of credit, understand as well that that is a non-taxable event because the IRS classifies it as debt, therefore it's not taxable. So if you want to know how to get wealthy, accumulate a lot of assets, borrow against it, and never pay tax legally. So accumulated equity in any one property cuts down on your power of financial leverage, and you don't have to pay that opportunity cost. You can keep your money working for you. So I don't want to have my home paid off by the time I'm age 45 or 65 or 85 or 105. I just can't justify paying that opportunity cost and not getting a return and having that much money all tied up in one home. See, if someone is of a different mindset, say I wanted to make an extra $1,000 mortgage principal payment on my home every month, basically here's what I'd be saying. Hey, Mr. Banker, here's an extra $1,000. Don't pay me any interest on it. If I need it back, I'll pay you fees and I'll prove to you that I qualify again. That's why I'm not interested in accelerating a mortgage paydown. But let's look at the downside now. Borrowing against the equity in your home, that does incur a real interest rate expense that you've got to pay. Now, interest rates are really low today, say 3 or 4%, but if I can borrow against my home at 3 to 4% and reinvest that somewhere else and beat that 3 or 4% over time, which is very likely that I'm going to be able to do that over time because 3 or 4% is really not that much higher than the prevailing rate of inflation over time, well then I am dollars ahead. Now I do think it's always a good idea to keep some liquidity around, but one thing that I like to do with equity that's separated from my home is buy another income property. And understand that when I do that, no equity is lost. Equity is merely transferred from my primary residence into another vehicle like another income property and actually reduce my risk in another way this way because when I transfer harvested equity from my home into another property, now I might be able to invest in 2 geographic markets, which brings me diversification and less risk. What about more risk? What if things really got bad and real estate values just fell everywhere across the board in every market, something similar to what happened in 2008? Well, then what? Well, then where would that leave me? Well, as long as I buy income property where the rent income meets or exceeds all of that property's monthly expenses, I'm going to be able to control the mortgage. Even if values are temporarily suppressed, it really won't matter because all that debt's outsourced to a tenant. I could pay off my home's mortgage pretty quickly if for some reason I wanted to, but if I did and I had to go sell income properties in order to do that, I would lose the cash flow from the income properties, and the cash flow that comes from the number of income properties I have to sell in order to pay off my loan, that cash flow exceeds my mortgage payment. So not only would I be dollars behind and reduce my cash flow, I would actually contract the size of my real estate portfolio. Well, I want to expand and keep the size of my real estate portfolio large if I am an adherent to the fact that over any long time horizon, 10 years, 20 years, 30 years, real estate goes up in value over those long time horizons, not down. So I want to have a larger portfolio, not a smaller one. I can do that when I have small equity positions in many properties and benefit from all that leverage. We're really talking here about why financially free beats debt free. Financial freedom is that ability for you to do whatever you want to do, pretty much whatever you want to do it, because you have income streams that show up in your life like rental income streams or dividend income streams that continue to recur with little or none of your own participation. I would rather participate in that rather than try to get debt-free on a home. Financially free beats debt-free. The financial freedom occurs when you take idle equity and you use it to create cash flow streams. Well, debt freedom, that would be just the opposite. That's using cash or cash flow to build equity. I'm going against myself and what I really want. No one shrinks their way to wealth. One acquires financial freedom by buying income property with long-term fixed interest rate debt and doing that in diverse markets with diverse economic sectors so that you do have tenants that can pay the rent and service those mortgages for you. Outsource your debt. Most people that work breathlessly to try to get debt-free, they tend to have this mindset that money is scarce and they need to scrimp and save for a decade or decades. But I think one needs to realize what a worthy goal really is, and you got to understand that some delayed gratification is good, but if you scrimp and save for decades, you're never going to get that time back. So instead of living below your means, think about expanding your means. It's about that expansionary mindset. That's what you have the ability to do when you think unconventionally, when you get some financial education, and when you act. Forces like leverage and arbitrage and velocity are more powerful than retiring low interest rate debt that's even tax advantage debt. And yes, there is that truth and that blasphemy that leverage creates real wealth compared to compound interest, which does not, after you subtract out the negative forces from compound interest of inflation and emotion and taxes and fees and volatility. If a magician came in and waved a magic wand and somehow paid off my primary residence's mortgage balance for me, I would pretty promptly get the bank involved and leverage my property again and get 80% cash out, which is usually what you can do, because I understand that having all that money tied up in my home where there's no return spells a substantial opportunity cost for me. And you know, I think for people that are still on this mindset of, well, I just want to have my home paid off, understand where that mindset often came from. People never got a financial education, and they really never learned then that, say, back in the 1930s, Great Depression, for example, a bank could call your mortgage loan due for any reason, then that you pay the entire mortgage balance in full right away, back when banks needed cash, when there were runs on the banks in the Great Depression. That simply can't happen anymore. Without getting into all the details, mortgages cannot be called payable due in full by banks anymore. That just can't happen. But it's that thing about 90 years ago that instilled all this fear into people. And why do these myths perpetuate sometimes? A lot of times it's just because we never had a genuine financial education where you're getting one right now. And you know, here's the thing, I still do seem to hear some people say things like, well, I know it doesn't make financial sense to pay off my home, but you know what? I don't care. It would just make me feel better. I would just feel better if I didn't have to worry about a housing payment anymore. Oh no, you still need to worry about a housing payment even if your mortgage is paid in full. Because even with a completely paid off mortgage, you're still every month going to owe property tax. You're going to owe property insurance. Oftentimes you're going to have maintenance and repairs and remodeling and utilities and HOA costs and all those other expenses that come with the home. So my point is that even when your mortgage is paid off, you don't retire your housing payment. All you've done is reduce your housing payment. So even winning wouldn't feel as good as you thought it would. So it's really not a game worth playing anyway to try to retire it, because you're never going to retire your housing payment. And the other thing to keep in mind is that all those other housing payments that I mentioned, like property insurance and property tax and repairs and maintenance and so on, they are all indexed to inflation. They continue to rise over time. The one recurring payment that's not indexed to inflation, which is your principal and interest payment with these long-term amortizing mortgages, these 30-year and 15-year mortgages like most people have, that doesn't rise with inflation. So if you just keep it there, it actually gets easier to pay off over time. If you have a mortgage payment of, say, $1,000, after 1 year on an inflation-adjusted basis at a 3% inflation rate, you effectively only owe $970 a month. And after year 2, $940 a month, and so on. Well, if you pay off your home, that's the thing that you'd retire, the one that actually gets easier to pay back over time if you just leave it in place. Again, financially free beats debt free. Paying off your home denies you the opportunity to invest, And you know what? Everything that I've talked about in this video has been true over time. It's been true for decades. It was true even back in October of 1981 when mortgage interest rates were 18%, and that's what you would pay if you borrowed against your home. But today, with mortgage rates at historic lows, this financially free beats debt-free mantra, based on the fact that your return from home equity is always zero, has never been more advantageous, because when you borrow against your home, you're paying lower mortgage interest rates than anyone has in history. And the other reason it's a good time is because there has been a lot of appreciation lately, hence a lot of idle equity that is sitting on people's balance sheets doing nothing. So everything that I just said has been true for decades or generations, but it's never been more advantageous to anyone in any generation at any time than it is right now. So that's why I do what I do, and I'm really telling you specifically how I got ahead farther, faster than most anyone else, because I not just know this, but I apply this and truly believe in it. So that's how I built wealth through real estate. A lot of it has to do with that. I didn't get any inheritance. I don't come from a wealthy family. I never had a high-paying job. I just keep my money moving and working on something and don't pay the opportunity cost of having it sit idle. And you know, most people don't think this way, and most people aren't financially free when they're young enough to enjoy it anyway. And you know what? It actually gets even worse for home equity. I'm not even describing everything that's wrong with home equity. It's even worse than what you think. But on Get Rich Education Podcast, episode 327, I explain even more of this. That episode is called Debt Free is Dumb, on Get Rich Education Podcast, episode 327, where you can learn a lot more there and really get you thinking about some things and how you can create returns for yourself. Hey, well, subscribing to the channel here is great. I'm always bringing you this unconventional financial commentary that really helps make a difference in your life. Click the notification bell too, along with your subscription. I learned that a lot of our videos didn't get delivered to our subscribers recently because they didn't click that notification bell. This way you'll gently be notified when I've got a new video here for you. I'm Keith Weinhold. I love talking today about why home equity is unsafe, illiquid, and its rate of return is always zero. Thanks so much for stopping by.
Americans are not saving for retirement. It's going to get worse as people live longer, so you need to think differently, but you can't lose your time. Real estate is the investment vehicle that has created more million and billionaires than anything else. Get Rich Education is one of America's top investing shows disrupting Wall Street. Your host, Keith Weinhold, is a true financial educator and has been an income property investor since 2002. Get Rich Education has created millions in passive monthly income for its followers. Now, Keith has a free book, The 7 Money Myths That Are Killing Your Wealth Potential. Get your copy now at getricheducation.com/book. Invest in what produces income for you now and later. Use the link in the description to download for free The 7 Money Myths That Are Killing Your Wealth Potential. Get Rich Education is on every podcasting platform and has its own native iOS and Android apps. Join Get Rich Education Nation to create financial freedom through real estate investing. Subscribe wherever you listen.